What I'm about to share with you isn't speculation, it's not fear-mongering, and it's definitely not something you're going to hear on CNBC. This is about a legal clause that's sitting in your savings account agreement right now, a clause that gives your bank the legal authority to delay your withdrawal by 7 days without giving you a reason, without triggering any headlines, without making any public announcement whatsoever. I'm talking about Title 12, Part 204, Regulation D of the Code of Federal Regulations. And here's what it says, word for word. A depository institution reserves the right at any time to require 7 days advance written notice of an intended withdrawal from a savings deposit. Look, I know what you're thinking. You've had your savings account for years. You've never seen this. You've never heard about it. That's exactly the point. This clause exists as a pressure valve. And what I'm seeing in the data right now tells me we're getting closer to the moment when banks might actually need to use it. What I'm going to walk you through today is not a crash. It's not a panic. It's a sequence. A quiet procedural sequence that begins with a legal framework most depositors don't know exists, builds through the specific financial stress that's accumulating on bank balance sheets right now, and ends at a place where the decision of whether you can access your own money is no longer entirely yours to make. I've spent years watching these sequences unfold. The names change, the triggering events change, the headlines change, but the mechanics don't. And once you understand the mechanics, you stop waiting for a headline to tell you something has started, because by the time the headline arrives, the first 3 moves of the sequence have already happened. The architecture you don't know exists. So here's the thing. Most people think their savings account works like a vault. You deposit money, the bank holds it, you withdraw it whenever you want. That's not how it works. Not legally, not structurally, and definitely not during a crisis. When you deposit money at a bank, you're making an unsecured loan to that institution. The bank records it as a liability on its balance sheet and then deploys those funds into loans and securities. You become a creditor, and in a resolution scenario, your claim is subject to a very specific priority hierarchy that was redesigned after 2008. Let me walk you through how we got here, because you can't understand where we're going without understanding the architecture that was built to manage exactly the kind of stress that's building right now. The year is 1933. Between 1930 and 1933, over 9,000 banks failed in the United States. Not restructured, not bailed out, failed, gone. The savings of millions of Americans evaporated, not because they spent the money, not because they made bad investments, but because the institution holding their deposits ran out of liquid funds to honor withdrawal requests. The money was there on paper, it wasn't there in cash. And once other depositors figured out that the bank couldn't pay everyone at once, the run began, and the run guaranteed the outcome it feared. This is the fundamental instability at the core of fractional reserve banking. Your deposits are the bank's liabilities, but those liabilities are backed by assets, loans, and securities that cannot be instantly converted to cash at full value. The system works as long as everyone doesn't ask for their money at the same time. The moment they do, the math breaks. What followed was a fundamental redesign of the relationship between depositors and the banking system. The Federal Deposit Insurance Corporation was created. Deposit insurance was introduced, reserve requirements were restructured, and embedded into the very definitions governing what a savings account legally is. Regulators wrote in a reservation of rights for banks, the right to require advance notice before releasing funds. Not a permanent right to refuse, a temporary right to delay. A valve. For most of the next 9 decades, that valve was never needed because the system was operating within its design parameters. Runs happened at individual institutions, but were contained quickly. The FDIC would step in, make insured depositors whole over a weekend, and the system would continue. The valve was a redundancy, like a fire suppression system in a building that's never had a fire. You stop noticing it's there. But then the savings and loan crisis arrived in the 1980s, and what it revealed was that the architecture built after the Great Depression had a gap. It could handle individual bank failures. It could not easily handle systemic failures across an entire sector of the banking industry. Between 1986 and 1995, over 1,000 savings and loan institutions failed in the United States. The Resolution Trust Corporation was created specifically to manage that wreckage. Taxpayers absorbed over $120 billion in losses, and regulators began designing a more permanent answer to the question of what happens when the crisis is too large for the insurance fund alone. That answer arrived in full after 2008. And this is where the story becomes directly relevant to the money you have sitting in a savings account right now. The bail-in framework nobody talks about. After the global financial crisis, the Financial Stability Board, which coordinates financial regulation for the G20, published a new framework for resolving failing banks. The core principle was simple. The cost of a bank failure should be borne primarily by the bank's own stakeholders, not by taxpayers. The framework is called bail-in as opposed to bailout. In the United States, it's embedded in Title II of the Dodd-Frank Act under what's called Orderly Liquidation Authority. In the European Union, it's the Bank Recovery and Resolution Directive. In the United Kingdom, it's the Banking Act of 2009. In Australia, Canada, and across the G20, variations of this same framework are now law. The Financial Stability Board coordinates its implementation across 24 jurisdictions worldwide. Here's the specific mechanism, and I need you to understand this clearly because it's going to matter in the next section when I show you the data. When a systemically important financial institution enters a resolution process, the FDIC or equivalent regulator takes control. Shareholders are wiped out first, then junior bondholders take losses, then senior unsecured bondholders, and then, if additional capital is needed to make the institution viable again, uninsured deposits above the insured threshold can be converted into equity. Not withdrawn, not returned. Converted. You become a shareholder in a recapitalized version of the institution that just failed. Your claim on cash becomes a claim on equity in a restructured bank that may take years to fully resolve and may return cents on the dollar. Now you might be thinking, that's just theory. That would never actually happen. Let me show you Cyprus, March 2013. The two largest banks in Cyprus, Bank of Cyprus and Laiki Bank, were restructured under a process coordinated by the European Central Bank and the International Monetary Fund. Depositors with balances above $100,000 lost up to 47.5% of their savings. Those funds were converted into bank equity. The banks reopened on a Monday. Depositors who had been customers their entire lives discovered that the rules they thought governed their money had been rewritten over a weekend. The Financial Stability Board's documentation from the period following Cyprus described what happened as a successful proof of concept for the bail-in framework. Those words are in their published record. Not hidden, not classified, published, the template was formally codified, the framework was expanded, and the legal architecture that allows depositor funds to be converted into equity during a bank resolution now governs every major Western economy on the planet. So here's my question for you. Do you know how much you have sitting above the $250,000 FDIC insurance limit? Because if you don't, you need to figure that out right now, because what I'm about to show you is the data that tells me this framework might not stay theoretical much longer. The $500 billion problem nobody's pricing. In all right, let's get into the numbers because this is where the story moves from history to what's happening right now on bank balance sheets across the United States. As of the end of 2024, according to data published by the Office of Financial Research, aggregate unrealized securities losses across all FDIC-insured banks in the United States stood at $481 billion. Let me repeat that, $481 billion. That number represents approximately 19.9% of the aggregate equity held at banking subsidiaries nationwide. Nearly one-fifth of the entire capital cushion that's supposed to absorb losses in the banking system is sitting in paper losses that don't appear on income statements because the assets are designated as held to maturity and therefore don't need to be marked to market unless they're sold. By the spring of 2025, as reported by Fortune, that number was approaching $500 billion as the 10-year Treasury yield rose again in response to renewed inflation pressure and the uncertainty introduced by the tariff environment. A Stanford finance professor, who has served as an expert in systemic banking risk, told Fortune directly that at a 10-year yield above 4.5%, the banking system starts seeing serious problems. At 5%, it becomes quite bad. As of this recording, the 10-year yield is in exactly that zone. Now here's why this matters, and I need you to follow me on this because this is the mechanics that most people miss. These losses are unrealized. They're disclosed in balance sheet footnotes that most depositors never read. But the moment a bank is forced to sell these securities, maybe to meet deposit outflows, maybe to raise liquidity during a stress event, the paper losses become real losses. The real losses destroy the capital cushion, and once the capital cushion is gone, the regulators arrive. Let me give you the accounting structure here because it's critical to understanding how this stays hidden until it can't be hidden anymore. Under current accounting standards, banks classify their securities holdings into three categories: trading securities, available for sale securities, and held to maturity securities. Trading securities are marked to market every quarter. Banks hold very little in this category because they don't want the volatility hitting their earnings. Available for sale securities are also marked to market every quarter, but the unrealized gains and losses bypass the income statement and go directly to equity. This means the market value changes are visible on the balance sheet, but they don't affect reported earnings unless the securities are sold. Held-to-maturity securities are not marked to market at all. They're carried at amortized cost. The bank's stated intention is to hold them until they mature. As long as the bank doesn't sell, the unrealized losses remain off the income statement and are disclosed only in the footnotes. This is the category where the $500 billion problem is sitting. Banks loaded up on long-duration treasuries and mortgage-backed securities during the zero-rate era when yields were compressed and prices were high. Now that rates have risen sharply, those securities are underwater, but as long as the bank doesn't sell, the losses don't hit capital. The vulnerability is liquidity. If deposit outflows force the bank to sell those securities before maturity, the unrealized losses crystallize immediately, and that's exactly what happened at Silicon Valley Bank in March 2023. What Silicon Valley Bank revealed about the entire system, SVB, wasn't a rogue institution. It was doing what hundreds of regional banks were doing during the zero-rate era. It was buying long-duration treasury securities and mortgage-backed securities to earn yield on deposits that were growing faster than loan demand. The bank's deposit base grew from $61.8 billion at the end of 2019 to $189.2 billion at the end of 2021. That's a 206% increase in 2 years. Most of that growth came from venture capital-backed startups and tech companies flush with funding. Those deposits needed to be deployed somewhere, and loan demand wasn't keeping pace. So SVB did what seemed rational at the time. It bought highly rated, long-duration securities. By the end of 2022, SVB held $117 billion in securities, with an average duration of approximately 6 years. And when interest rates rose sharply in 2022, the market value of those securities fell by approximately $17 billion. That $17 billion loss was larger than SVB's total tangible common equity. The bank was technically insolvent on a mark-to-market basis, but as long as depositors didn't panic, the bank could hold the securities to maturity and avoid realizing the losses. Then confidence eroded. On March 8, 2023, SVB announced it had sold $21 billion of available-for-sale securities at a loss of $1.8 billion and was raising $2.25 billion in new capital to plug the hole. The announcement was supposed to reassure investors. It had the opposite effect. It confirmed that the bank was under stress, and depositors with large uninsured balances began moving funds. Within 48 hours, depositors attempted to withdraw $42 billion. That's 22% of the bank's total deposits in 2 days. The bank couldn't meet the outflows. The California Department of Financial Protection and Innovation closed the bank on March 10th. The FDIC was appointed receiver. By Monday morning, SVB had ceased to exist as an independent institution. Now here's what I want you to understand. SVB wasn't unique. It was just the first domino, because hundreds of regional banks are sitting on the exact same portfolio of long-duration securities that are underwater at today's interest rates, and they're all hoping they don't have to sell. The Office of Financial Research published a brief in May of 2025 that stated the implication precisely. Unrealized losses could increase banks' vulnerability if other developments, such as a large surge in commercial real estate loan losses, make depositors question a bank's viability. And that brings me to the second part of this story, the part that's building right now in real time, the commercial real estate time bomb. I've been tracking commercial real estate delinquency data for the past 18 months, and what I'm seeing is a pattern that looks disturbingly similar to the lead-up to 2008. Except this time, the exposure is concentrated in regional and community banks. Commercial real estate delinquency rates for office loans in the United States reached 10.4% in the second half of 2025. That's approaching the 2008 peak, and it represents the fastest rate of increase in this data series on record. Regional banks hold approximately 44% of their total loan books in commercial real estate compared to 13% at the largest banks. This concentration creates asymmetric vulnerability. The largest banks, JP Morgan, Bank of America, Citi, Wells Fargo, can absorb commercial real estate losses across a diversified loan portfolio. Regional banks cannot. Now, here's where it gets really interesting. New loan-level research published in late 2025 found that latent distress in commercial real estate meaning loans that would be underwater at today's property values, even if they're not yet formally delinquent, is approximately 4 times larger than what current delinquency statistics imply. Let me translate that for you. The banks are not recognizing these losses yet. They're using a practice called extend and pretend, modifying loan terms and pushing out maturity dates to avoid formal default recognition. This is masking the scale. Here's how extend and pretend works in practice. A commercial real estate loan comes due. The property is worth less than the outstanding loan balance. The borrower can't refinance because no lender will finance a loan-to-value ratio above 70% to 75%. The borrower can't pay off the loan because they don't have the cash. Technically, this is a default. But instead of foreclosing and recognizing the loss, the bank modifies the loan. It extends the maturity by 1 to 3 years. It may charge a higher interest rate. It may require a small principal paydown, but it avoids formal default classification. The loan remains classified as performing, and the unrealized loss stays off the income statement. This works as long as property values stabilize or improve before the new maturity date arrives. But if property values continue declining, which is exactly what's happening in the office sector, then the problem gets worse, not better, and the bank is simply delaying the inevitable recognition of a loss that grows larger with each extension. Over $1 trillion in commercial real estate loans were scheduled to mature by the end of 2025. The maturity pressure extends through 2026 and 2027. When those loans mature, the borrower either pays off the balance, refinances at current rates, or defaults. There is no fourth option. And here's the problem. Refinancing at 6% to 8% on a property that has declined 30% to 40% in value is not economically viable for most commercial borrowers. Let me give you a specific example to make this concrete. Say you own a Class B office building in a secondary market. You took out a $10 million loan in 2018 at 4.5% interest with a 7-year term. The property was valued at $14 million at the time, giving you a loan-to-value ratio of 71%. The loan comes due in 2025, but the property is now worth $9 million because office occupancy has dropped from 92% to 68%. Tenants are demanding rent concessions. New leases are coming in 20% to 30% below pre-pandemic levels. You approach a lender to refinance. They're willing to lend at 75% loan-to-value at 7.5% interest. That's $6.75 million. You still owe $9.2 million on the original loan. To refinance, you'd need to bring $2.45 million in cash to the table just to pay down the loan to a level where the new lender will finance it. You don't have $2.45 million, so you default. The bank forecloses. The property sells for $8.5 million after a 6-month marketing period. The bank takes a loss of $700,000 plus legal and carrying costs. Multiply that scenario by thousands of properties across hundreds of regional banks, and you start to see the problem. The extend and pretend window has a hard limit, and when it closes, losses that have been building for 3 years will need to be recognized. So now let me connect these two data sets for you, because this is where the unrealized securities losses and the commercial real estate losses converge into a single stress event. The sequence that's already been written. A regional bank with concentrated commercial real estate exposure begins reporting elevated loan loss provisions. This appears in its quarterly earnings. The investment community flags it as a credit quality concern. An analyst publishes a note. A local financial journalist picks up the story. Within 24 to 48 hours, depositors holding uninsured balances above $250,000 begin calling the bank. Some begin moving funds. The bank's overnight funding position starts deteriorating. The bank's treasury team activates its liquidity contingency plan and begins drawing on Federal Home Loan Bank advances to pad its short-term cash position. But here's the problem. Federal Home Loan Bank advances require collateral. The bank pledges its securities portfolio as collateral. But if the bank has already pledged those securities to secure other funding sources, then its collateral is exhausted. The bank now faces a choice: sell securities at a loss to raise cash, or invoke the 7-day notice clause to slow deposit outflows while it sources alternative funding. One of the tools in that contingency plan is the 7-day notice clause. The bank doesn't need a regulatory order to use it. It doesn't need to declare an emergency. It doesn't need to make a public announcement. It activates a right that has existed in its deposit agreements since the accounts were opened. Customers receive a written notice. Withdrawals are delayed. The bank has bought itself 7 days to source alternative funding, to negotiate with regulators, to explore a sale or merger, or to prepare for a formal FDIC resolution process. From the depositor's side, the notice is the first visible signal that something is wrong. But the bank's balance sheet stress didn't begin the day the notice arrived. It began months or years earlier, building through unrealized losses, deteriorating commercial real estate performance, and compressed lending margins. The notice is not the beginning of the problem, it's the moment the problem becomes impossible to manage in private. And here's what happens next, because this is where the sequence accelerates in ways that most depositors don't anticipate. The moment the 7-day notice hits, word spreads. Social media picks it up. Local news covers it. Other depositors at the same bank, people who weren't initially concerned, now start questioning whether their money is safe. They call the bank, they visit branches. Some decide to move funds as a precaution, but now there's a 7-day delay, so they can't move funds immediately. They're stuck waiting, and that waiting period creates more anxiety, which creates more withdrawal requests, which creates more pressure on the bank's funding position. Meanwhile, depositors at other regional banks with similar commercial real estate exposure start asking questions. Could this happen at my bank? They start reviewing their balances. They start calculating how much is above the FDIC insurance limit. Some decide to move funds proactively before any 7-day notice arrives at their institution. This is how localized stress becomes systemic contagion. It's not a crash. It's a sequence of rational individual decisions that compound into a collective run. Now here's what most people get wrong about the FDIC. They assume the insurance fund provides a complete backstop. It doesn't. The FDIC's $150 billion problem, the Deposit Insurance Fund held a balance of $150 billion as of the third quarter of 2025, representing a reserve ratio of 1.40%. That means the fund covers 1.40 times for every $100 of insured deposits in the United States banking system. Total insured deposits are measured in the low tens of trillions. The fund is sized to handle individual bank failures. It is not sized to handle a simultaneous stress event across multiple institutions in the same sector. Let me give you some historical context here because it helps illustrate the constraints. When Washington Mutual failed in September 2008, it held $307 billion in assets and $188 billion in deposits. It was the largest bank failure in U.S. history. The FDIC brokered a sale to J.P. Morgan Chase over a weekend. J.P. Morgan assumed all of WAMU's deposits and acquired its assets at a steep discount. The FDIC didn't pay out a single dollar from the insurance fund because the resolution was structured as a purchase and assumption transaction. But that structure only worked because there was a healthy acquirer with the balance sheet capacity to absorb WAMU's deposits. If multiple large regional banks fail simultaneously, there may not be enough healthy acquirers to go around. And in that scenario, the FDIC would need to use the insurance fund to make depositors whole. The math doesn't work if the failures are concentrated and large. A single $50 billion bank failure could consume 1/3 of the fund if structured as a payout, rather than a purchase and assumption. 3 such failures would deplete it entirely. The FDIC has been transparent about this constraint in its published documentation. The orderly liquidation authority exists precisely because the fund alone cannot address a systemic scenario. In that scenario, the resolution process relies on the bail-in mechanism to recapitalize failing institutions using the institution's own liability structure, including uninsured deposits, rather than drawing down the fund. That's why the framework exists. It's the FDIC's institutional answer to the question of what happens when the insurance pool is not large enough. And the answer is that uninsured depositors become part of the recapitalization. Let me be very clear about what this means for you practically. If you hold more than $250,000 at a single institution, the excess is uninsured regardless of the institution's apparent stability. The FDIC's institutional lookup tools are public and free. You can verify your coverage at edfdic.gov. Spreading deposits across multiple FDIC-insured institutions to remain within the insurance limit at each is straightforward. If you have $750,000 in cash, you can spread it across 3 banks with $250,000 at each, and you're fully insured. Joint accounts have separate coverage. If you and your spouse hold a joint account, that account is insured up to $500,000 because each co-owner is insured up to $250,000. If you also hold an individual account at the same bank, that's insured up to another $250,000. Retirement accounts like IRAs have separate coverage as well. But here's what I want you to understand about the bigger picture, because this is where the constraints on the system become really important. Why this time is different from every other crisis. In every previous banking crisis, there was a backstop of last resort. In 1933, it was the creation of the FDIC itself. In the savings and loan crisis, it was the Resolution Trust Corporation funded by federal appropriations. In 2008, it was TARP, $700 billion in congressional authorization, combined with the Federal Reserve expanding its balance sheet from under $1 trillion to nearly $3 trillion in a matter of months. In 2020, it was a combination of zero interest rates, $4 trillion in new Federal Reserve asset purchases, and direct fiscal transfers at a scale not seen since World War II. Each of those interventions worked because the conditions for them existed, the fiscal capacity was available, the political consensus for intervention was achievable, and the starting point before the crisis meant that the monetary and fiscal tools had room to operate. The starting point today is different in a specific and measurable way. The United States federal debt stands above $36 trillion as of early 2026. The interest payments on that debt are running at an annualized rate that exceeds the entire defense budget. In fiscal year 2025, the U.S. government paid over $800 billion in net interest expense. The Federal Reserve's balance sheet, even after the quantitative tightening that began in 2022, remains over $7 trillion. The Fed funds rate has been held at 3.5% to 3.75% as of the January 2026 FOMC meeting, with inflation described in the Fed's own statement as remaining somewhat elevated. What this means is that the tools available in 2008 and 2020 have limited room to operate today. Cutting rates to zero again would require the Fed to accept that inflation, which is already elevated, will rise further, and the Fed's credibility on inflation has been damaged by the 2021-2022 experience when inflation reached 9.1% in June 2022, the highest level in 40 years. Expanding the Fed's balance sheet through new asset purchases would add to a balance sheet that's already historically unprecedented in size. Congressional authorization for another TARP-style program would require bipartisan political consensus on fiscal spending in an environment where the national debt and its interest costs are already a primary policy concern. The political environment in 2026 is far more polarized than it was in 2008. This is not a prediction that the tools won't be used. Central banks have repeatedly demonstrated a willingness to expand their intervention toolkit when the system is under sufficient stress. But the starting conditions determine the cost of the intervention, and the cost today is higher than it has been in any previous crisis, which means the resolution is either more expensive, more inflationary, or requires a mechanism that doesn't add to the government's balance sheet. The bail-in framework is that mechanism. It's resolution without new taxpayer money. It's recapitalization using the bank's own liability structure, meaning the deposits, bonds, and equity that are already on the balance sheet. It doesn't require congressional authorization. It doesn't require the Federal Reserve to print new money. It requires only that the FDIC invoke its existing legal authority under Title II of Dodd-Frank. This is why the architecture matters, not because it will necessarily be used, but because it exists. It's the lowest cost option for resolving a systemic banking stress from the government's perspective, and the constraints on every alternative option are higher today than they have been at any previous decision point. So now let me give you the framework for what you should be doing with this information, because understanding the structure is one thing, acting on it is another. What you should be tracking. Right now, I'm going to lay out 3 levels of action here, and I want you to understand that these don't require an active crisis to justify. They require only an accurate understanding of the structure you're currently inside. First, review your deposit coverage. If you're holding more than $250,000 at a single institution, the excess is uninsured. Spreading deposits across multiple FDIC-insured institutions to remain within the insurance limit at each is straightforward. But there's a second layer here that most people miss. Not all banks have the same risk profile. You can look up your bank's financial condition using publicly available data. The FDIC publishes quarterly call reports for every insured institution. Look at the bank's commercial real estate concentration as a percentage of total loans. Anything above 300% of the bank's Tier 1 capital is considered elevated by regulators. Look at the bank's unrealized securities losses disclosed in the footnotes. Compare that to the bank's tangible common equity. If unrealized losses exceed 20% to 30% of equity, that's a yellow flag. Look at the bank's deposit composition. If a large percentage of deposits are uninsured, then the bank is more vulnerable to a run because those depositors have more incentive to move quickly during stress. This information is public. You don't need special access. You just need to know where to look. Second, understand what physical assets outside the banking system represent in this context. Gold and silver held in physical form, in your possession or in allocated segregated private storage, sit outside the banking system. They're not subject to the 7-day clause. They're not subject to orderly liquidation authority. They're not part of any institution's liability structure. Central banks globally purchased record quantities of gold in 2024 and continued accumulating through 2025. According to the World Gold Council, central banks added 1,037 metric tons of gold to their reserves in 2024. That's the second highest year on record. China, Russia, India, and sovereign wealth funds across the Middle East have been systematically building gold reserves. These are institutions with the analytical resources and regulatory access to understand exactly what's on the balance sheets of the Western banking system. They're not buying gold because they expect a collapse next week. They're buying gold because they're managing against the tail risk of a system that their own analysis tells them is under structural stress. They're doing exactly what the legal architecture of the system suggests is rational for any creditor who wants assets that cannot be converted or delayed. Silver, trading at a significant discount to its historical ratio relative to gold, faces additional supply constraints from industrial demand in solar manufacturing, electric vehicles, and defense applications. Physical silver demand has been exceeding annual mine supply, and above-ground inventories are at multi-decade lows. The historical gold-to-silver ratio has averaged around 60-1 over the past century. As of early 2026, it's trading above 80-1. That suggests silver is undervalued relative to gold on a historical basis. When I talk about physical metals, I mean physical, not ETFs, not futures contracts. I mean metal in your possession or in fully segregated allocated storage, where you have direct legal title and can take delivery on demand. The distinction matters because during a crisis, counterparty risk manifests in unexpected ways. Third, understand timing and optionality. The decisions I just outlined, reviewing your deposit coverage, understanding the legal architecture of your accounts, establishing a position in assets outside the system, they don't require an active crisis to justify. They become materially harder to execute once a confidence event is underway at a specific institution, because by then the sequence is in motion, the queue is forming, and the 7-day clock may already be running. Think about what happened at Silicon Valley Bank. On Wednesday, March 8th, the bank announced it was raising capital. By Thursday morning, venture capital firms were telling their portfolio companies to move funds out of SVB. By Friday morning, the bank was closed. If you were an SVB depositor with $2 million in an operating account and you decided on Thursday afternoon to move funds, you were already too late. The window closed faster than most people anticipated, and that's the nature of bank runs in the digital age. They don't happen over weeks like they did in 1933. They happen over hours. The time to review your exposure and make adjustments is before the headline, not after. Where we are right now. Let me state where we are with the precision the available data permits. Bank balance sheets in the United States carry close to $500 billion in unrealized securities losses, representing approximately 20% of aggregate banking system equity. Commercial real estate office delinquencies are approaching 2008 peak levels at the fastest rate of increase ever recorded in this data series. Regional banks hold nearly half their loan books in commercial real estate. Latent distress in that sector is estimated to be 4 times larger than formal delinquency statistics currently reflect. The FDIC Deposit Insurance Fund has a 1.40% reserve ratio, above the statutory minimum, but not sized for a systemic event. The bail-in framework is legally active across all major Western economies. The 7-day notice clause is sitting in your savings account agreement right now, available to be invoked without external authorization, without a public announcement, and without any headline to warn you it's coming. What's not yet determined is the specific trigger. It's not known which institution, which earnings report, which commercial real estate maturity default, or which external shock will convert this latent stress into a visible sequence. A Stanford finance professor who studies bank fragility stated it directly in May 2025. The ingredients for stress are still present, especially if macroeconomic conditions deteriorate. He's describing a system that's loaded, not one that's discharged. But a loaded system and an unloaded system require different responses from the people inside it. What I'm watching next, I will be tracking the FDIC quarterly banking profile when it publishes. The next one is due in late February 2026. I'm specifically watching for changes in unrealized securities losses, deposit flows at regional banks, and commercial real estate loan classifications. I will be tracking commercial real estate maturity data. The Mortgage Bankers Association publishes quarterly data on loan maturities. I'm watching for any acceleration in maturity defaults or extensions. I will be tracking regional bank earnings disclosures. Fourth quarter 2025 earnings season is underway. I'm watching for any increase in loan loss provisions, any deterioration in commercial real estate performance, and any comments on deposit stability. I will be tracking Federal Reserve balance sheet reporting. The Fed publishes weekly balance sheet data every Thursday. I'm watching for any changes in bank borrowing from the discount window or the Bank Term Funding Program. And I will be tracking any regulatory filings that indicate specific institutions are approaching the stress thresholds I've discussed today. Banks file call reports quarterly. Those reports are public. If you know what to look for, you can see stress building before it becomes a headline. Because the sequence described in this video doesn't resolve in a single news cycle. It develops over months. Each stage will be visible if you know what you're looking at. The investors and depositors who came through the banking panics of the 1930s, the savings and loan failures of the 1980s, the financial crisis of 2008, and the regional bank failures of 2023 weren't the people who moved the fastest after the headline appeared. They were the people who understood the structure before the event, who read the actual account agreements, who recognized that a quiet clause buried in a regulatory definition is not a footnote. It's a feature that was deliberately designed and can be deliberately used. Your savings account is not a vault. Your deposit is a liability on a balance sheet. The insurance protecting it has a cap and a fund with quantifiable limits. The legal framework governing what happens if the institution holding your deposit encounters stress has been redesigned since 2008 to protect the system first and the depositor second, in that order, by explicit statutory design. This is not the end of the sequence. The next data points will arrive in the coming weeks and months. Stay with this channel because the next development in this sequence is not a prediction. It's a disclosure that's already been made somewhere, in a call report, in a regulatory filing, in a quarterly earnings footnote that hasn't yet become a headline. The job of this channel is to find it before the headline does. The only question that remains is whether you're watching this unfold from inside the system without understanding the rules, or from a position you chose deliberately because you read the fine print. I need you to do two things for me. First, leave a comment below and tell me, do you believe the Fed will step in with another bailout? Or are we actually going to see the bail-in framework activated? I want to know where the community stands on this because the collective intelligence of this audience matters. Second, if this analysis added value and helped you understand the mechanics of what's building in the banking system right now, hit that subscribe button. Because what I'm tracking next, the specific institutions that are showing stress signals in their quarterly filings, that's coming in the next video. And you're going to want to see it before anyone else does. Andrew John, and I'll see you in the next one.